The numbers are huge. Why are you still a private company? Why not go public now?
Yeah, I mean, we kind of see this as going public 6 months at a time, right? So we're allocating big blocks to the investors that are going to invest in us for many, many, years to come. In January, we raised $1 billion. That's reshaping our cap table to have the big mutual funds then. And now in this round, we're super excited to have the round be led by Morgan Stanley. So in some sense, it's kind of like a small IPO at the time, and we will be public at some point. But this is sort of something that's really advantageous to us to do in this way.
So you were last on the show to talk about that $1 billion you raised earlier this year, now $1.6 billion. At what point are you not going to be able to do this privately? What could you do as a public company you wouldn't be able to do privately, and vice versa?
Yeah, I mean, look, the main reason to go public is to provide liquidity to the employees, right? And that is top of mind for us. So for that reason, we will at some point IPO. But it's really nice to be able to actually sort of spread out the kind of allocation of capital to the company in sort of chunks like this. So we're taking advantage of that.
So when you're saying you're doing this to supercharge innovation, what does that mean? How do you put this money to work?
Yeah, we're expanding super aggressively, right? So we announced that we're going to actually open up a site now in Germany for R&D. So doubling down on Germany. We already have our Amsterdam site. Here we have San Francisco, we have South Bay. We also announced now with this fundraise that we're also going to start a site in Seattle. So a lot of it is going to go to R&D, but also go to market. Each of these countries, we have 20 offices worldwide, each of them to make sure that they're staffed up, that your product is localized to the language locally, that you can do support in the language on their time zone. It's costly. You can take 10 years, make profits, and reinvest it back into business to do that. Or if you have a lot of access to capital like we have, you can supercharge that and just do that extremely fast. And that's what we're opting for doing.
Now, we were just talking with Greylock's Jerry Chen about the castles in the cloud, if you will, the giants, Amazon, Google, Microsoft that are there, and the startups that are disrupting that hierarchy. You partner with Amazon, Google, and Microsoft. Do you see one of them or a couple being disrupted longer term, or do you see them generally holding down the fort and data cloud startups like Databricks sort of widening out the pie?
Yeah, I actually think that, these cloud vendors, they're here to stay. They're all growing at insane rates, and the numbers are large, right? And still growing really fast. So I think it's just, with IT all moving from on-premise to the cloud, we're at the beginning of it. So I think all three will do well. Some will do better in some areas, others will do better in others. But there is an interesting trend that's happening right now, which is more and more software companies or enterprises are saying, which one should I pick of these three? I don't want to maybe pick. Let me actually hedge my bets. I'm going to actually have my software work on multiple of the clouds. So multi-cloud is becoming a secular trend with lots of tailwinds for companies like Databricks and others that are multi-cloud. So that's, I think, something that you're going to see more and more and more of, because they don't want to, risk it and pick the wrong cloud. Also, they want to have negotiation leverage because, it can be pretty costly to spend all these, money on infrastructure. So if you have multiple vendors that you can, negotiate with, that's better for you as an enterprise.
Interesting. Well, speaking of multiple vendors, I know that companies can use both Databricks and Snowflake's products and services, but you also compete with Snowflake. Some of your products actually overlap. What do you think makes Databricks stand out from Snowflake? Why would you choose Databricks over Snowflake?
Yeah, look, I think Snowflake is a great company, and the numbers speak for themselves. It's fantastic. It's a data warehouse in the cloud. It's a multi-cloud data warehouse, one of the best out there. Databricks is different. Databricks is a data and AI company. It actually enables you to build what we call the lake house, the data lake house, where you can store all of your data. You can do machine learning on it, which you wouldn't use a data warehouse for. So that's a differentiator. You can do real time on it, which you typically don't use data warehouses for. And you can also do more and more data warehousing on it. So in the really long term, let's say in the next decade or so, I actually think the data warehouses will kind of be replaced and wither, and they'll be replaced by these data lake houses.
So you think a company like Salesforce and the way they do business is going to be replaced by the way you do business?
Snowflake, no, I think that the companies out there, they're going to readjust, right? It's a big enough market. It's the same thing as your question about which cloud vendor is going to win. All three are successful. I think there's big enough market for Snowflake to be around, for Databricks to be around, and also, frankly, other players that we haven't heard of yet. Jerry mentioned some in the previous, interview that you just did. Some of them will succeed as well. But I don't think there will be a place for the data warehouse as it is today. I think that needs to, either be revamped to a data lake house, or they need to do something with it. I don't think it, makes sense to have it around in the long term.
Give us a sense of your revenue and growth projections over the years to come. My former colleague Eric Newcomer reported in his newsletter you're looking at somewhere between $600 and $700 million in revenue. Is that on target? And what's next?
Yeah, I mean, we shared that we've passed 600 million ARR, annual recurring revenue, and that growth rate is about 75% year over year. So, that's really, really fast growth rate. And also, I think we should remember we're in the really early innings of artificial intelligence and machine learning. We're just scratching the surface. Most enterprises are not where, say, a Google or a Facebook or a Twitter is, but they will be in 10 years. So I think, the growth potential here is massive. It's going to go on for a long period of time. Mark Andreessen famously said that software is eating the world. You have software in your phone, in your thermostat, in your car. Well, I think AI is going to eat all of software. Wherever you have software, you need more intelligence and more AI and more data processing. And we are, a company that actually combines data and AI. So I think we're very well positioned here.